information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you. Now, Top Tips Wednesday continues with Your Money, Your Call.
Good evening, I'm Francesco Destratus from Audminet. If you have a question about shares, our phone lines are now open on 1300 30 34 35, or if you're a little bit shy and you prefer, you can email us on yourmoney@skynews.com.au. Join me on the panel tonight is Michael Heffernan from Phillip Capital and Carl Capolingua from Investor Systems. Welcome to the program, gentlemen. Well, a bit of a false start through the day. The market was sitting in neutral, but as soon as the Bank of Japan had made their announcement, the market took off. Carl, what are your thoughts on the activities in the market at the moment?
Yeah, well, I mean, the reason why banks rallied today is the Bank of Japan didn't go as far as some people were, I guess, fearing for the banking sector. It's hard for banks to make fantastic profits when interest rates are effectively zero, or in some places around the world at negative rates. So they didn't go quite as far as the market had predicted, and therefore we got a little bit of a push up in banks. Bringing it back home, I don't think the market's in a terrible state. The last few times I've been on the show, I've been advocating maintaining a modestly high cash balance. Seasonally, September is a bad month for the domestic market. We usually find a bottom sort of midway through October, and then we tend to have a rally through late October, November and into the year end. So I think from a technical perspective, I'm more of a technical analyst. The market's in reasonable shape. It's not the best quality uptrend I've seen. It's certainly not the worst either, though. I think we're going to muddle along. I think I'm from WA, so I keep a close eye on metals prices. Base metals have done actually pretty well. If you look outside the headline iron ore price, you've got, for example, zinc prices have almost doubled in about the last 9 months. Lead's up about 30-40%. So I think that there are some tailwinds there that maybe the broader market hasn't appreciated yet. I think we'll muddle along. I think you can start to put a little bit of that cash to work for some of those reasons and some of those seasonal factors. And I would say, as I tend to regularly say on this show, don't look in the top 20. Probably not even the top 50. I think you do need to get into those mid-cap stocks. There are still some great quality mid-caps out there. Get off the beaten track a little bit, do some analysis and find some of those hidden gems.
Okay, thanks, gentlemen. I think we'll move on to our first call, but I think we'll get some more analysis throughout the evening from our expert panel. We have our first call on the line. We have Jeff from Perth. Hello, Jeff. How are you? Are you there, Jeff? He might have hung up on us, I think. Let's move on. We can move on to an email. We have Warren who asks about Aconex, Vocus and TPG have all been smashed after disappointing results. Is this a good time to get into quality stocks? Also, what would be a good entry price?
Yeah, look, it's important, and all of those stocks did very well, and all came up on our systems as buys. 2 out of 3 hit stop 750 on ACX, $8 at Vocus. Would emphasise to the viewers the importance of having an exit plan. So if you've got an entry plan, you need an exit plan, and stop loss is one way to do it. We prefer not to have stops, what we call hard stops in the system. We call them soft stops when they get to a particular price point, a pressure point that we're looking at. We look for some confirmation, then we'll exit. As for what to do with those stocks now, I agree with Michael in that with your money, you should always be looking for the best of the best of the best opportunities. Mediocre is not good enough in my opinion. I want the best. I think in each of those cases, none of those charts from a technical perspective are looking like the money is moving back into them just yet. It still looks like money is moving out of those stocks. From a fundamental perspective, I agree with Michael in that if the double-digit growth is gone, but the 25, 30 PE is still there, they're going to struggle. So turn that on its head. Your job is to then look for stocks which are, and this is my philosophy, is to find stocks which have double-digit earnings growth, preferably somewhere between 10 and 20%, a PE under 20 if you can find them, and hopefully they pay a dividend, or because it shows they can manage their money. There are, in my opinion, about a dozen or so stocks that meet that criteria in the market. I'm happy to talk about them during the course of the show, and those three stocks aren't in that list. So, cut a long story short, if you have stocks which are underperforming, which don't meet those criteria I've suggested, there's in my opinion, no reason to hold on to them. You would sell those, realise the cash, and then go find the stocks that do meet the criteria. It's about constantly pruning out the dead wood and finding the new green shoots. And I don't think TPM, Vocus and Aconex are green shoots by any stretch of the imagination.
Okay, there you go, Warren. A bit of feedback there. These stocks have been hit pretty hard. Okay, let's move on. We have Jeff back on the line. He might have gone for a cup of tea. Hello, Jeff, are you there?
Yep, good evening. Macquarie Atlas is a stock that's had a pretty good...
Oh, I think we've lost Jeff again. But he's asking about Macquarie Atlas. At least we got the stock out of him this time. He's gone. Maybe a bit of a phone line issue with over in Perth. What do you think, Carl?
Maybe he's with TPM or Vocus. Yeah.
Maybe. Oh, that's a bit of a... Carl, what are your thoughts on Macquarie Atlas? Or?
Well, look, Macquarie and Transurban, both, quality companies, but I think in the last sort of 6 to 12 months, they've been moving less on their own fundamentals and more on the fact that yields, have been very low. It's hard to get good companies with good yields, and they've been in that subset of sort of utility infrastructure stocks that have been offering that. In the last few weeks, so if you're wondering why those stocks, TCL, Macquarie, and a few other utility stocks have been hit so hard in the last few weeks, is that we've had bonds come off. Local 10-year bonds have come off, and therefore the yields, because there's an inverse relation, yields have gone up. So, bonds considered to be your quote-unquote safe, risk-free bet, offering a better yield. These stocks, therefore, on a relative basis, not offering as good yields, and therefore they get a little bit hit. Or there's just an unwinding. I mean, there's a crowding into these stocks for that reason, and there's a little bit of unwinding of that. So I think if you...
Well, the price has got to a point where the yields weren't all that attractive either, particularly the roads businesses.
Well, I think if your view is that yields are going to continue to be low and the yields on these stocks are going to continue to be high, then this probably is a buying opportunity. So it's not typically my style to try and buy things that have plummeted like that. I tend to want to wait for a bit of positive momentum, but if your strategy is to find yield where there is very little yield elsewhere, they're quality stocks, and the yield's a bit better right now.
Okay, good. So let's move on to our next caller. We have Richard in Melbourne. Hello, Richard, are you there? Hello, Richard, are you there? Okay, I'm getting some feedback that Richard was talking about Macquarie Group. So why don't we have a bit of a chat about Macquarie Group and how they're going, Carl?
Absolutely. Look, I'll tackle this. I'll just give you a quick overview of my the way I do my analysis. So I won't know about every stock listed in the market, 2,500 Australian stocks. That's impossible to do. I've got very much a bottom-up approach, so I've some technical scans here. It's a system that I use it's a discrete set of rules. I run a scan over the market that comes up with a bunch of stocks which meet my technical criteria, which are based mainly on trend and relative comparisons. So are the stocks beating the market, and are they in strong and sustainable uptrends? For the stocks that meet that criteria, then I'll go and crack them open and have a look at the fundamentals, and when the two come together, we've got an opportunity. So I won't know a lot about the fundamentals of Macquarie Bank. The reason for that is it hasn't come up in those technical scans to give me a reason to go and do that analysis. So I'll comment simply on the technical standpoint. I think it is in a reasonable short to medium term uptrend. Longer term trend is very, very flat at this stage. I prefer to get into stocks where all of those three trends are in alignment. So you've got the shorter term traders, I guess the medium term swing traders, and the long term investors all thinking the same about the particular stock. I think it's had a pretty good run over the last sort of 6 months, from 60 obviously into 80. There's a lot of overhead supply. I think you'll see come in around about $80 because $80 to $85 because that's where the major swing highs were in 2015. And therefore, you might have a few larger investors looking to offload into some of the demand around this level. So for me, if I had the stock, I'd be looking to probably do the same, to be honest, to be looking to sell around current levels. I think you could see somewhere between 84 and 86 in the next few weeks, and I'd be looking to take some profits into there. If I didn't have the stock, this is not one I would be chasing really hard right now.
Okay. Now, I've been told one of the questions from one of our earlier callers was on Telstra. Now, just to bring it in line with what we talked about before the ad break, we talked about sort of Vocus and TPG and Aconex. What are your thoughts on Telstra then?
Look, I'm not a big fan. I get the angle of better than a term deposit. I don't disagree. So if that is your only strategy, then I have no problem with it. If you're after growth, share price growth and great dividends, which is what I'm after. So I want to find a stock that's going to go up and pays a great dividend. Why not? I mean, if you've got the ability to do it, why not do it instead of getting a stock that's probably going to go flat, maybe down a little and have a great dividend? You're going to end up having your dividend eroded by potential capital decline. The reason why Telstra is underperforming is that it really doesn't have any growth. Very low single-digit growth. It's less than the market. Yet, the PE's sort of high teens, which is more than the market. So you've got a stock here which is growing less than the market, but it's more expensive than the market. And then it's hard to really justify it as a growth opportunity, and really all you're left with is a dividend, and that is not good enough for me. So if I had Telstra, I actually think it looks quite vulnerable here to fall even further. I'd be getting out of it right now. If I didn't have it, this is definitely not one of the opportunities that I'd be pursuing.
Okay. Let's go straight to a caller. We have Ben on the line in Brisbane. Hello, Ben.
Hello.
How are you going?
Good, thanks.
That's
I'd just like to ask you guys about Nine Entertainment. Purely looking for the dividend, and considering it's dropped back so far, I'm just wanting to think that's a good investment for 5 to 10 years. Thanks.
Okay, let's start with Carl. Nine Entertainment.
Look, I get asked about this one regularly, it seems, when I come on the show. My response has been the same each time. It looks awful. Don't touch it. I can't see any reason why this current downtrend is going to change at this point in time. There's nothing in the technicals that suggest that the money's starting to come into this stock. In fact, it's really the opposite. It still looks like money's coming out. So you can see on the chart on screen, every time it tries to rally, it gets beaten down. It gets beaten down more than it went up. It tries to rally, it rallies less, and then it gets beaten down again. So that's still a big sign of distribution. There's nothing in the volume to suggest that there's been that cataclysmic turnover of holders and new money coming in. So it's definitely an avoid if you don't have it. If you do have it, there are so many better opportunities out there for you to pursue than this one.
The old opportunity cost, I think, is better elsewhere. Okay, we have another caller on the line. We have David from WA. Hello, David.
Good evening, gents. I'm just making inquiries about Beta Harvest, Dividend Harvester share, and it's been given a fairly decent return the last 12 months, paid monthly. I'm just wondering, my concern is around the share price, whether it's sustainable at these levels where it is at the moment, still continuing to deliver the yield it does.
Okay, thanks for your question, David. Look, these things are generally priced from the underlying assets, so it's hard to sort of conceive where the underlying shares are. But let's have a look at Carl and see what he has to say about the dividend harvester.
Yeah, look, exactly what you said there, Francesco. So it's not its own entity. It is based upon a bunch of other shares. In this case, a bunch of large cap Australian shares, it says here, high yielding. And
so what you're reading there, is it actively managed, or is it just a
good question? Look, I'd never heard of it. I'd never heard of it until I just Googled it, and I'm looking at it, so I can't answer that question whether it's actively or passively managed. I'm going to guess it has to be actively because they're selecting what goes in there. So the answer to the question is it depends on what the underlying shares are doing as to what the share price is doing. Just be a little bit careful with this one. You look through the numbers here and it says it's got an 11.8% per annum return. which sounds fantastic in this day and age where you're getting about 2.5% in a 6-month, 12-month term deposit, right? So on the face of it, looks brilliant, and a lot of investors would be drawn to that. However, the share price is down about 5.5% over the last 12 months. So on the plus side, you've got 11.8% dividend distributions. On the downside, you've got share price depreciation. Part of that is because of the dividends that are being distributed as well. So the net return's about 6.5%, which is still pretty good. But not as great as you might think. So just be a bit careful. I can't see any reason why a lot of those large cap Australian high dividend payers are going to bound off upwards anytime soon, and that's a very broad statement there without looking at them individually. So on that basis, I would say that don't expect a lot of share price appreciation. If you're happy with your 6.6% and the franking credits that are attached to it, then stick with it. Okay, if that's your goal. If you're like me, you're looking for growth, capital growth and dividends at the same time, then this is not one to be holding.
Let's move on to our next caller. We have John on the line in New South Wales. Hello, John.
Yeah, hi, how you going, guys?
Good, mate. Yeah. What's your question?
It's on Data 3. I was just wondering if you had any idea about why it's been going down. And just on Telstra before, I've got to stick up for Carl, because to me it looks like since 2015 it's been in a primary downtrend and it's like dropped 20%. So isn't your yield actually negative over the last 12 months?
Well, your return might be negative, but not your yield. No. But that's,
Yes, but if you lose 20% capital, it doesn't matter how much yield you get, you're still in the dirt.
Yeah, well, the ANZ Bank's down 30% in the year, or it was a couple of months ago.
Yeah.
So does that actually make them effective yield stocks?
Depends on the investor and how they if they need to sell it. I mean, really, their income hasn't changed, but their asset base has changed. So, if your expectations are that Telstra is going to continue to fall, then yes, you'd probably have to be looking elsewhere. And it's where we come into that dividend yield, or what did you call it? The dividend.
Harvesting.
No, the dividend trap, I call it.
The illusion.
The dividend illusion.
Yeah, right.
So, John, 100% right. Yeah. The total return might have come back, but some people are sitting on these shares for a long period of time, and it depends on the investor. If they're looking for growth, ultimately, then you wouldn't be investing in Telstra if you're looking for growth.
No.
So, let's get on to your question about Data 3. Carl.
Data 3 is a stock that I covered last time I was on the show. I covered 2 stocks, and this was a buy around about 120, high 120s I think it was. We had a target in at 160. We exited the stock, and I can't say we foresaw that decline. It just hit our price extension target. So we did quite well on it. If you're still in it, the reason why I mean, the technicals look great, but the reason why I was so keen on the stock was that the fundamentals were fantastic to back it up. Nothing, I mean, they released their report since I was on this show last. They exceeded expectations, in fact, and nothing's really changed since that report. So I think fundamentally you've still got the same company. However, you've got a big downward move on the chart, and I think the reason for that is a lot to do with Vocus has struggled as well. So, they're all in a very similar industry there, and TPG today, obviously, also. So I think it's been tarred with the same brush. I do think fundamentally it is still a great company. It does have double-digit growth. It has a reasonable mid-teen PE. It's got a great yield, 5.5% fully franked. So if you still think that all of those factors are still in place, I think you're getting it at a bit of a discount for no other reason than it's been tarred with the brush of those other companies.
Okay, let's move on to our next caller. We have Richard on the line from Melbourne. Hello, Richard.
Yeah, hi.
I think you were meant to be on them before.
Well, I was. I think it was a technical problem.
No, we heard you talking. We hung up on you, I think, maybe.
Yeah, I could hear you, but I don't think you could hear me. It just destroyed my
okay.
life. Yeah.
Okay, Richard.
No, you did answer my query in respect to Macquarie Bank. The other one was just one of the panel's view about Kogan, KGN, which is floated in July, and it's an online retailer.
Okay.
So just wanted the panel's thoughts on that as to whether it's worth looking at or how I should think about it, yeah.
Okay, thanks for your question, Richard.
Okay, thanks very much.
Carl,
Absolutely.
it's hard for you to get a gauge on, I suppose, for any
look,
trends or anything like that.
It's almost impossible. You hit the nail on the head. You know, you can have a good business, but the market needs to find the right price for that business. And obviously, businesses need to be growing as well. Look, I can't say on this one. My technical models, which are really the cornerstone of my methodology, you know, that's how I identify the stocks initially to then go and do the further work on. There's just not enough data for those models to come up with a yes or a no on this one. So if you don't know, the best thing to do is to say pass.
Okay. Things to look for though, Richard, you know, out of the prospectus, have a look at what they're predicting their earnings to grow by over the next 12 months. You know, if there's some growth there and they're delivering on that in the early days, there's potentially some upside there. But it's hard because some of these IPOs, I think, it's hard to put it, you know, nicely, but priced sometimes for perfection. That's right. Yes. We have an email from Dee who asks, I'm looking to butt into either APA or Duet. Are they similar businesses, and which one would you recommend out of the two? Carl, your thoughts on APA and Duet?
Look, I think I'd start off by saying I'm not a buyer of either of those stocks at this point in time. I think there are better opportunities out there. However, if the question is pick between the two, and that's my job, so I will. I think Duet is the better company. It's got a far more stable growth profile. It's got more growth in it. It's got a much lower pricing in the market, so it's more reasonably valued in the market, and it's got a better dividend yield. So, you know, three important things to consider there. From a technical standpoint, looking at the chart, I think Duet also has the better chart. It's got more support around the current levels than APA does. APA is at risk potentially of breaking down here and maybe moving into a downtrend. Duet's still holding its uptrend. So from a technical perspective, Duet. From a fundamental perspective, Duet. There's your answer.
Okay, thanks, Carl. No, I'd have to agree. I think Duet's probably the better proposition. We maintain it in one of our income portfolios at Ord Minnett. Not saying APA is a bad investment, but I think there's a potential there for a little bit of growth, not a lot, out of Duet, and that maintaining that good yield that they have. But both are very good defensive investments there, Dee. Now we have another email. We have an email from Peter who asks, can you advise which stock you prefer from a medium-term holding, AGL or Origin Energy? Okay, Carl, let's start with you. AGL or Origin?
AGL or Origin, okay. Again, two stocks that I haven't covered any time in the recent past. They just haven't met my technical criteria. Both, obviously, utility stocks. Both hit hard. If you overlay a chart of those high-yielding utility/infrastructure stocks, or look at the XUJ, the utilities index on the ASX 200, all of those stocks are almost identical, and they're almost identical to the bond prices as well. So, you know, I think it's been a real yield play on those. I think you've got a really crowded trade, which has been unwound to some extent. If you're looking for yield and you think that, I think I'm repeating myself from before, but if you think that global yields, local yields are going to stay very low, nothing's really changed with these companies and the yields are slightly better. If that is your objective, then, you know, take your pick of either of those. I'm not too fussed. I would say, much like the last two I had to choose from, I'm not a buyer of either of these anyway.
Okay. Let's go to another caller. We have Andrew on the line from New South Wales. Hello, Andrew.
How you going?
I'm good, mate. What's your question?
So my question is primarily about Duet Group International, but it's kind of a broader question in terms of the government's overhaul of the vet fee scheme. So CIDA are an educator, and about 2/3 of their income reported in the last financial year were on the debtors list, which was mainly from the government. And I wasn't sure if you guys knew anything about the overhaul, and if I guess the likelihood of this group getting their income out of the government.
Okay, thanks for your question, Andrew. It's a fairly in-depth one. And education has been a bit of a growth area for Australia. Not necessarily have been focused on it in the market, but government regulation change it tomorrow. What was that stock that did the novated leases?
Macmillan Shakespeare.
Didn't they get hit when they changed it? Well, they never changed the regulations.
They never got changed.
They made an announcement.
Halved in price.
That was Uncle Kevin, wasn't it?
Yeah, one of them.
He did. No, he got up on the lawn there and made the announcement without anybody knowing about it and no consultation.
I don't think his cabinet knew about it.
Stock halved in price, and it was a brilliant trend. It was you had the stock and it was brilliant.
Oh, you had the stock
and halved in price overnight.
Unfortunately,
you're going to hit.
Unfortunately, in the market, no one can predict a lot of this sort of stuff, and you always get hit in left field. I mean, look at TPG the other day. Everyone was expecting growth, and all of a sudden they've taken that growth out of it, and the market punishes it. Carl, what are your thoughts on Site Group, though?
Look, just not one I've heard of, hasn't come up on my technical scans. Had a quick look at it, and to answer, I guess you provide maybe provide a bit more detail. They are doing education for mining, oil and gas, construction industries. And I'm from Perth, and those industries are not flying at this point in time. And we are in a recession by stealth over there. So I would say they're in a tough area at this point in time. But at
the same, as you mentioned that, at the same time, those mines still have to operate and they still have to train people. So maybe there's just not as much as was going on, say, 5 years ago than is going on today. So, but I mean, looking at that
market wants growth, market wants fat, and I don't think the fat's there. But that's me licking my fingers, sticking it in the wind, seeing which way the wind's blowing analysis. I prefer, if I don't know enough about the company, to look at the chart, because the chart's going to tell you not what you think about it, but what the rest of the market thinks about it. So the people that are doing the great analysis, really nailing down these companies, delving into them, looking at the management, looking at their operations, looking at their future, and if the company had something going for it, you would find that there would be more people out there trying to acquire the stock at a particular price than there are people looking to sell it. And the price therefore would be going up. That's not the case here. The price is down, is in a downtrend. It's a pretty consistent downtrend. In fact, it's been at best flat since inception, and inception looks like somewhere around about 1992. So I don't think if you've had this stock, if you've been a shareholder of this stock for the last 30 years, you've actually made any money at any time. So based upon that track record, it's not one for me. If I had it, I'd be out of it. If I didn't have it, I would be avoiding it. I know that's not what the caller wants to hear. He wants to hear me gush about it and tell him it's the best bloody thing I've ever heard of, but I simply can't do that.
Yeah. The difficult space, as we've all just mentioned, for various reasons. But I think the key, mentioned it just before, is that government regulation. They can provide more funding, they can remove funding very quickly in an environment where everyone's trying to find budget cuts. You know, this is probably an easy one that can sort of miss out on some government funding, I think.
Yeah, I think that's a big problem.
Yeah. But let's go straight to our next caller. We have Adonis on the line from Melbourne. Hello, Adonis.
Francesco, how are you?
I'm well, mate. What's your question?
A couple of questions for the boys tonight on two stocks. One which I own, Bapcorp, and I've in since a break out of $5. And another one that I'm looking to add, Sydney Airports. Just a bit concerned, the medium trend is still a little bit bearish, although it has had a bit of a bounce off 650. So if I can get a technical, and also yours and Mike's view, particularly with Sydney Airports, why it's sort of underperformed a little bit throughout the course of the year. Thank you.
Sure, thanks, Adonis. Carl, what are your thoughts on the technical approach to... Let's start with Sydney Airports, because he's looking to get into that.
Sure. Look, Sydney Airports is, again, another one of those utility/infrastructure stocks, much like Macquarie, TCL, what are the other ones we've talked about tonight? AGL. They all look identical. They're all mirroring bond yields. It was a very crowded trade, and some of the money came out, and that's what you're seeing. Again, if you're in it simply for the yield, if that's all you're chasing, the yields are better, and if your view is that broader yields will stay low, then on a relative basis, this fits with your strategy. It's not my strategy. I want growth and yield. So on that basis, for Sydney Airports, it's a pass for me. It's definitely not the worst thing I've seen. It's still overall a great uptrend. It's just not meeting my key technical criteria at this point in time. On BAP, that one looks very, very good. It's been a very consistent performer from a price perspective. So on the technicals, it's a wonderful trend, one of the better trends out there. In fact, I can't see anything in the charts that are telling me that this trend is going to end anytime soon. So it looks very sustainable, looks very steady. If I had the stock, I would very, very much stay with it. If I didn't have the stock, this is not my top pick in that area. I think there is a better stock out there in terms of the technicals. I think I like the. I'll give you the stock. It's AMA is the stock, and it's AMA Group, and the ticker code is AMA. It's in the same sort of automotive area. It does some manufactures some items and does some aftermarket as well. But it's got a really great broad base pattern. It's just breaking out through 110. So from a technical perspective, I think it's superior to BAP, although BAP is very good. But I think the key between the two stocks is on the fundamental side. AMA's got much more consistent growth, earnings growth, better growth and consistent growth. It's better price, it's better value, I think, than BAP. And the yield, I can't remember comparatively off the top of my head. But if you're interested in that space, I think AMA is a better pick out of the two.
Okay, thanks, Carl. We have an email from Glenn who asks, I see my shares in Soul Pattinson going below my buy price. Is it exposed to TPG Telecom, and would you still rate Soul Pattinson's as a buy at below $16? Also, do you see any hope for my ACR shares? Okay.
Oh, not one.
You'll have that on your screen very promptly.
Acrux.
Yeah, you can see it on chart now, and it looks absolutely horrific. And that only gives you a small picture of just how bad ACR has been. It's been a significant underperformer for a very long period of time. From looking at about 18 months, it's fallen from 270 down to 36 cents. And you had many opportunities. In fact, every day the market was open to take your medicine on this one and get out and go and find something better to do with your money. If you haven't done that, it's not at zero yet. So I guess you've still got some time. If you're not in the stock, then I would not touch it at all. This is the worst strategy you could apply is to try and find these bottom-dwelling, fallen angel stocks. Invariably, sometimes they take years to build a base pattern before they start to have that upwards momentum, and it's only after that base pattern and that upwards momentum that I could become interested in it. Soul Pattinson is not one that's come up on my technical scan, so I haven't had to go and do the research on it. Having a quick look at the chart, it's in a bit of a range. Overall, the broader trend is still very good, and I think that's encouraging. Look, I'm going to leave it at that. Look, it's stuck in a range. It's at the bottom of the recent range. So if it's just fallen beneath your entry price, well, two things can happen. It moves back up to the top of the range and you're happy again, or it breaks down through the bottom of the range and then you need an exit strategy. Okay, so don't just be holding on forever and ever and ever. Amen. You need to know where you're going to get out of the stock. So set that now in advance.
Being wound up, one quick stock. Don't give me any reasons, just...
Servicestream.
Servicestream. Have a look at Servicestream. Michael, what's yours?
CSL.
CSL. Good. Both of them very good, I think. That's all we have time for today, sorry. But thanks so much to our guests, Michael Heffernan from Phillip Capital and Carl Capolingua from Investor Systems. And to you, our viewers, for all of your emails and calls, until next time, I'm Francesco Destratus from Ord Minnett. Thanks for your company.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.